Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what's next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone, from Long Island, New York. This is Michael Hartzman, along with my partner, Dominick Tavella. And today is Tuesday, January 19th, which means only one thing. Tomorrow is January 20th, which is Inauguration Day in our country. And I think we could all agree that this has been a run-up to an inauguration unlike anything we've ever seen in our lifetimes, Dominick.
Yeah, so Mike, we have a new year. January 1st rolled the clock into a brand new year. Hopefully, we're all praying for a better one than the prior, but this is a new beginning. We are going to have 4 years ahead of us of a new administration, new rules, new guidelines, new attitude, new everything. And certainly anytime change comes along, that adds a certain level of stress to ourselves and our clients, and what is the picture going to look like going forward. So tomorrow is the beginning of a new day, new dawn.
It really, really is. And we love in our business analogies and euphemisms and acronyms. And one of our favorites when we talk to our clients is headline risk. Oh, there's nothing to worry about. That's just headline risk. And our job is always to determine, well, when does headline risk become real risk, right? When does this unknown virus that's named after a beer come to America and completely turn our country upside down, right? In the beginning it was headline risk, and all of a sudden you and I are thinking, we better get a little bit more defensive because this is not some little thing in China heading our way. This is a problem. And we dealt with that last year. And in getting ready for the show tonight, I was thinking of the rioting at the Capitol on January 6th. And if I had to bet you what the market did that day, you would have probably assumed that once the TV shown a camera on all these people storming the Capitol, the market would have sold off. And what was fascinating to me is the market sold off a little bit, but the market actually closed up that day 1%. So you're thinking, all right.
I'm going to interrupt you only because it was up substantially that day. Mm-hmm. So even though the S&P and the Dow did end the day higher, the NASDAQ lower, it gave back a lot of the gains that we had that day. And we thought that was opportunistic, but let you finish your sentence. Sorry about that.
No, it's okay. So then you think, all right, people are going to come home from work and people are going to turn on the TV, and the next day, it's definitely going to go down the next day. So what happens the next day? The S&P goes up 2.5%. And you're thinking, all right. So I guess people really weren't that worried about what they saw or really weren't that attached to it as related to the overall markets and the economy. And then the third day, January 8th, it actually went up 3%. So the day of the storming, it went up 1. The next day it went up 2.5, and then the next day it went up 3. And that to me is a typical example of headline risk, because you and I would get the phone call, are you watching TV? Yeah. Are you seeing what's going on? I need you to sell everything, right? So that was a perfect example of when we mentioned headline risk. That is classic headline risk.
So it doesn't always work out this way. I joke, we don't always get this lucky, but when we look at headline risk, we have to evaluate just how much of an issue is this going to be, right? The headlines literally scare people. People react to that. And like I said, although two of the three major indices were up that particular day, the markets were up huge before that popped on our TV set. So the markets gave back a very, very large amount of that gain. From our perspective, we looked at it and maybe guessed right, maybe guessed wrong. In hindsight, we were lucky we guessed right, but we saw that as an event that frightened people in the moment and that it would and could resolve itself. So we use that as a buying opportunity. As you know, Mike, we bought, if our own clients look back at their statements, we bought on that day. And because we determined at the time that we thought the overall risk would be minimal, and that it would resolve itself. Maybe taking some amount of time. Didn't think it was going to happen that quick, like you just described, Mike. Normally it takes weeks or months for these kind of issues to resolve themselves. But if you can be opportunistic, you can build some value into clients' portfolios. Having said that, clients react emotionally to those headlines, right? They make decisions instantly at the moment, letting fear overtake common sense. And usually the end result, which could be weeks, months later, is, oh, I wish I had not reacted that way. Right?
Of course. So, and then I guess last week, I guess reality did set in to some degree because the market finally went down a little bit. Finally, like, what's going to make this market go down at all? And I guess the story that all 50 states in the union are preparing for riots, God forbid, this week and tomorrow, that finally gave the markets a little bit of pause to say, let's just see what happens. I mean, hopefully that doesn't happen. And right now, God willing, it appears that will not happen. It hasn't happened yet, thank God. And hopefully tomorrow's quiet and the inauguration goes off without a hitch. But, so the market was down, a grand total of 1.46% last week. But it was really interesting that it finally took that threat to have the market, finally slow down a little bit.
Yeah, take a pause. So if, we'll try, both of us will try very, very hard not to react emotionally and try to use as much common sense as possible. So short term, literally tomorrow, maybe over the next couple of weeks, we're going to react to these headlines and I'm sure there'll be some drama. But on a longer term basis, what do we expect out of the Biden administration versus the Trump administration with regard to policy and economic input and where do we think the economy is going to be year end and how do we react to that, right? How do we create portfolios that can ride that and more important, hold our clients' hands through the roller coaster ride? So what are your expectations for the Biden administration, Mike? What do you think they're going to do?
So here's what's really interesting, right? So a lot of clients would call me up and say, well, I want to get out of the market because Biden is going to raise taxes and Biden's going to put all these regulations in. And I think we have to still stay in the moment, right? Because I think in the moment, the Biden administration will be stimulative because here's another part of the upside down world we live in. They just approved the $600 stimulus for and $1,200 for a married couple. And then Trump comes along and says, no, that's not enough. We should give them $1,000. And then the Democrats say, that's a great idea. And this is the first time in 4 years that I used to joke around, if Donald Trump would put a Mercedes-Benz in every Democrat's driveway, they would still hate Donald Trump, right? I mean, he couldn't do anything that they agreed with. So here we are in this upside down world where Trump is on the side of the Democrats, right? And then when the Senate in Georgia turned blue, it almost became an expectation now, right? That well,
they promised it, right? They promised it during the Georgia elections. So.
That this stimulus is going to come. So I think in the short run, the market continues to look forward to the vaccine, and we're going to get this short-term shot in the arm that Americans are going to get, who need help, are going to get some badly needed money. So again, apolitically, not taking a side, I am very optimistic about the beginning of the Biden administration for that reason.
So, Mike, I as well have gotten many a phone call. We talked about this earlier, and people are very concerned. There's a lot of unknowns here about what the Biden administration would do, could do. We try to calm those fears. The fact that the Senate is equally split. I know that the vice president would get a vote there, but the House is a lot closer than it was under the Trump administration, the split between Democrats and Republicans. So you don't need a lot of Democrats to jump ship on these issues to just shoot any really progressive, way out and left field type of legislation. I think that's given the market some solace that we're not going to get anything completely off the rails here. And then you and I were part of a study that showed that if you look at the total return of markets during a Republican administration versus a Democrat administration, that the numbers were not dramatically different. You would think that their policies are so dramatically different that the end result would be different. But returns during a Democratic administration versus those of a Republican were not dramatically better or worse. And in fact, it really came down to that particular administration and whether we had a 9/11 crisis or a financial industry crisis like we did in 2008. But there isn't that much of a difference. The economy itself seemed to have its own life, and that carried the day. So I think that's a message we really have to make sure we pass on to our clients.
Right. And the takeaway, I remember that day well, that was before the election. And the takeaway was there's only been two administrations that had a negative stock market, Richard Nixon and George W. Bush. Richard Nixon, because he didn't finish his term, because Gerald Ford actually had a great stock market, which was basically Nixon's term, the end of his term, and W, because he left in the beginning of the Great Recession. But I was surprised to learn that every administration, Republican or Democrat, had a positive stock market, save for two, and both had, unique reasons why they didn't have the opportunity to be positive as well, which, again, I would have bet money that was not the case. But heartened that it was the case.
Yeah, and again, back to this is a message we have to get to our clients. But the portfolio does need to look different, right? So at the beginning of a Trump administration, we were in one economic cycle and we purposely rebalanced the portfolio to look much more growthy oriented and an environment where we thought growth would be accelerated. This portfolio, our new portfolios going forward, are going to be a little bit more muted and a little bit more rebalanced. We'll pass that message as we go here. But we do are reacting to, and we will be rebalancing the portfolios for our new administration.
Mm-hmm. Yeah, I mean, again, that's our job to always kind of, dancing on the fly. So as you know, you and I have access to many great resources, and our next guest will be John Mackay from the Schroders Fund, which is a division of Hartford. So we actually spoke to John earlier, and he's going to talk about his sense of the market, where he thinks things are going. He's going to mention Europe, which we don't talk about that much. So I'm glad we had a chance to bring that up with him. And, please stay tuned for our next guest, John Mackay, who's an investment strategist at Schroders, a division of Hartford Funds.
You are listening to the Lebenthal Report. If you're listening to the show live, join in on our discussion with questions or comments at 1-866-472-5790. You may also send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
Our next segment, we are really excited to have John Mackay with us from Schroder. Terrific investment firm, longstanding history, and really one of our core partners in creating these portfolios. So let's get the experts in here and hopefully get some pretty good opinions about what we have to look forward to. John, are you with us?
I'm here. Good to be here. Thanks for having me.
John,
hey John,
welcome to the Lebenthal Report.
Great to be here.
Appreciate you taking the time. So happy to have you on board and really kind of looking forward to your opinions We've had a pretty interesting year end and a new one starting. So why don't you kind of just jump in with your thoughts on the subject matter, and then we'd love to pick your brain.
Sure, I'd be happy to. So the way we're thinking about it is the old economic cycle ended on March 23rd, 2020, and the new economic cycle started. And I'm picking that date because it was the bottom of the S&P 500's drawdown that was around 33%. The market started rallying from there. And really what we were looking forward to was a reopening of economies, not just in the US, but around the world, on the back of fiscal stimulus support, monetary support, as well as an eventual vaccine announcement, which we got in November of last year. And what we've seen happening underneath the surface of the market is essentially a rotation out of those stay-at-home trades, sort of consumer staples, big, large cap internet stocks, into cyclically oriented stocks. And what I mean by that is stocks that are very sensitive to the economic cycle. So if you think about the way the US market is made up, it's much more skewed to stay-at-home than it is to sort of the reopening trade or the cyclical trade. And so what we've seen happening around the world is economies, markets, sectors that are more exposed to a cyclical reopening are doing better than those that aren't. So the leaders have become the laggards have become the leaders. And so that's how we think things are going to play out over the next year or so.
John, we were talking early this morning in our Dom and I do a call every Tuesday morning with our advisors, and we were talking this morning how the goalposts for the reopening of the country and the world keep moving. Originally Dr. Fauci said we should all be back at ball games and concerts by July, and then I read a few weeks later, September. This morning, the WHO said all of 2021 will be what will it take to get to herd immunity. So at what point does the market get tired of waiting, or does the market retrace its gains because we keep having this reemergence push back?
So I don't think it's black and white like that, right? You're going to have certain countries around the world are going to be ahead of others. We've already seen this happening with Southeast Asia. And, the pushback I've gotten to saying, well, China's gotten the virus under control is you can't believe the numbers in China. But what you can do is you can look at travel data, you can look at energy usage, you can look at restaurant bookings. You can also do the same thing for a country like South Korea, which is much more open than China is, and the data is much more reliable. And so I think as we move through this year, you're going to see countries that are either more effective at distributing the vaccine. They've done a better job at curbing the rise in coronavirus cases and the capacity at hospital emergency rooms. We've seen that with a very strict lockdown in the UK right now. The virus numbers are currently very bad there, but they will get better as they go through that very strict lockdown. Countries like France and Germany are implementing more strict lockdowns on a national level. And I think you'll see exactly the same thing happening here in the US, where states like West Virginia are actually being fairly successful in distributing the vaccine. Other states, New York and California most notably, are struggling with it for various reasons. So I think it's very hard to say that by the end of 2021 is when things will be officially reopened. I think it's going to be a staged reopening by state, by county, by country around the world. And so I think what the market's pricing in is somewhere around the middle of the year, things are going to be better than they are today, which means economic activity will be better. And I think what the markets have been pricing in late last year was much better economic growth this year. That's what we expect at Schroders. We expect a very strong year from a global economic perspective. We think growth will be led by emerging markets. We think the US is going to grow by 4% plus this year, Europe by 5% plus this year. Part of that is calendar effect. Part of that is obviously just people being able to get out there and live their lives again. And that's what the market's priced in. But I think, the difference is this year, we're not going to have 50, 60, 70% plus returns in equity markets. They're going to be much more muted. And I think that's the point you were trying to make, which is that there will be bad news. There will be hiccups along the way. There will be stumbles along the way. And the markets will sell off a little bit on that. But I think the way we're thinking about it is use those moments as a chance to continue the rotation out of the winners that we've seen over the last couple of years into the winners going forward, which will be those cyclically oriented stocks.
So, John, I've looked at Europe, certainly this last year, is almost like a leading indicator of where we are in the status of the virus. And it seems like they were 4 to 6 weeks ahead of us from the peaks to trough, now back to peak. So I'm looking at us over the next 4 to 6 weeks, and I see things getting substantially worse before they get better, but then hopefully they do get better. How do you think markets are going to react? Are they going to finally wake up to the short-term risks here, or they're just blinders on?
I think, this is going to sound callous, but I think a little bit of blinders on. And a big piece of that is a combination of two things. One is we've seen this before, so it's not a surprise this time. We know the data is going to be bad. We've seen record-setting new virus cases here in the US. We've seen record-setting, unfortunately, mortality rates in the US. But we know that we know how to deal with it. We know how to live with it. We know how to treat it better than we did before. And we also have in our back pocket significant fiscal stimulus. Obviously, the $900 billion package that was passed over the Christmas break. Biden is talking about another package that we estimate will be somewhere between $900 billion to maybe $1 trillion. And you've also got the Fed, who's basically said they're not going to touch they're not going to pump the brakes whatsoever until we see average inflation move above 2%. We don't know how far above, and we don't know how long, but that is a lot of firepower. From a fiscal and a monetary perspective, coupled with the fact that we're, as I said before, used to this, coupled with the fact that household balance sheets are in pretty good shape. So we have the ability to withstand this resurgence in the virus. And you could say the same exact thing about Europe. You could say the same exact thing about a resurgence of the virus in other parts of the world as well. It's sort of once bitten, twice shy. We know how to deal with it. We've seen this before. It's not a surprise. I guess what would surprise us is a new strain of the virus that wasn't able to be treated by the vaccines that have been rolled out over the past couple of months. That's another positive, by the way, is we will get more vaccines on top of the 2 that have already been approved. We will have another 2 or 3 within the next 6 to 8 weeks that are approved, not just here in the US, but around the world. And those numbers can be added to the vaccination rollout that we've seen over the past sort of 4 to 6 weeks.
So let's focus. We finally reintroduced international exposure in our portfolios, I guess about 6 months ago, primarily on the weakness of the dollar. We thought that trend would continue, ultra low rates here in the US, finally compared to the rest of the world. So maybe a focus on international markets in general and emerging markets, if you'd love to jump in on that one.
Yeah, so I think there's 3 things to think about when you're thinking about international. One is you want valuations to be cheap. You need a good starting point. That's, cheap markets can stay cheap for a long period of time. We've seen that with Europe. We've seen that with emerging markets. They've been cheaper than the US for effectively the last decade, and they haven't done anything. You've had a year here or there that's been good, but effectively they've stayed cheap, and they've stayed cheap for a good reason. The good reason is lack of earnings growth. You need earnings growth to move those markets higher. What we've seen in estimates over the next year and 2 years is significantly stronger earnings growth out of Europe, Japan, and emerging markets versus the US in 2021 and 2022. We think that's going to be the driver to push prices back up to a level that's comparable to what we see here in the US. The third reason is the cyclical makeup of those markets. So more than 60% of the US equity market is what we describe as non-cyclical. It's communications, it is info tech, it is healthcare, and it is also consumer staples and utilities, which are effectively defensive stocks. If you look overseas at Europe, Japan, and emerging markets, it's more than 60% of those markets are cyclical. So if we get that cyclical, growth impulse, which we think we've seen already, those markets should do better as they're more skewed to that, they're more tied to that. The last piece of the puzzle is what you talked about earlier, Dom, which is the weakness in the dollar. If you look over long periods of time, and I'm talking about 40 to 50 years, When the dollar is going down, international does better than the US. When the dollar is going up, international does worse than the US. We've seen that over the last 10 years. The dollar strengthened, international has lagged. In the previous 10 years, the dollar weakened, international worked really well. And it almost goes up and down about every 10 years. I'm generalizing here, but that's a fair way to think about it. The 90s was the US, the 80s was international, the 70s was the US, and so on. The driver of the dollar tends to be a couple of things, but deficits matter. Twin deficits especially. We're going to have the worst twin deficits here in the US going back to the 1940s. So that's our current account deficit, as well as our fiscal deficit. Current account is how much we buy or sell from other countries, how much we're selling to them, how much they're buying from us. We tend to buy more than we sell overseas. That's our trade deficit. Fiscal deficit, not surprisingly, is worse because of all the fiscal stimulus that we've put into the economy to try and support the slowdown in growth. Ours is worse, by the way, than the rest of the world. Worse than Europe, worse than Japan, worse than most emerging market economies. The other piece of it you touched on, which is interest rate differentials and growth differentials. We're not going to grow as fast as the rest of the world, all else being equal, this year here in the US. So the growth advantage we enjoyed for much of the past decade is now gone. We should at best be equal to countries like Germany, France, and Italy. And obviously most of emerging markets is going to grow faster than us. That's been true quite some period of time. So we think the weakness we've seen in the dollar over the last year will continue. If you're investing overseas, you're investing in local shares, you're bringing those share returns back to the US. And if the dollar is weaker, you will get a boost to your returns. And so those are all the reasons: valuations, earnings growth, economic growth, cyclical skew in international, and obviously a weaker dollar will help international equities, we think, do better.
So John, let me ask you this. 4 years ago, there was much ink spilled and a lot of anxiety about the Brexit. And here we are 4 years later, and it's official. And I know there's other fish to fry here in America, but could you talk a little bit about the Brexit as it relates to the UK and the rest of the EU? Can they both win? Are there going to be winners and losers? Is this something we should be worried about here in America?
No, it's, as you said, it's amazing to hear 4 years ago was the vote in the summer of 2016, and they've finally finished the negotiating process and Brexit is done. They have put a set of rules in place for taxes on goods that are going into and out of the UK from Europe. And there are some rules in place that may make those taxes go up or down depending on things like workplace practices, environmental practices, regulations around worker compensation, basically fairness rules. If UK tries to take a particular industry and give them a competitive advantage, then taxes are going to go up in Europe, and vice versa. If Europe tries to do that to a particular industry and give themselves a particular advantage for goods going back into the UK, the UK can then tax those goods higher. So I would argue that it puts the UK at a slight disadvantage versus where they were before, where they just, it was free trade of goods. Now there are these additional rules and complications, which makes doing business more difficult, as we all know. The more complicated the rule books are, the more difficult it is to get business done. But all else being equal, we at least have a roadmap now through which we can figure out what trade will look like, what impact that might have to earnings, what impact that might have to economic growth of the UK. And so at least you have a roadmap to run your investments by, your roadmap to run your businesses by. And so I think we can, to a large degree, put the Brexit to rest now. We can hopefully get rid of that terrible term, which has been hanging over the markets, at least from a European perspective, for the last 4+ years.
John, I got one last question, if you don't mind. And unfortunately, it's probably a long answer, but I'll do the best you can.
Okay.
Really under the radar, this is not a political question, but China just signed an accord with the EU, and it looks like there's going to be a significant amount of euros coming into Europe and help them grow economically. I think that could be a further fuel in the fire economically for Europe. Any opinion on that?
Yeah, so I think a lot of it honestly ties back to Europe's efforts to grow their presence in emerging markets as a trading bloc. So Europe exports more to emerging markets than they do to the US or just about any other developed economy in the world. China is a huge piece of that. And I think the deal you're seeing is an effort by Europe to further gain access to a burgeoning middle class, specifically within China, which is roughly 400 million people. If you think about that compared to the size of the US, we've got 340, 350 million people. You've got a burgeoning millennial class, which likes luxury goods, a lot of which come out of the European Union. And so I think, if Europe signs this deal, and as you said, a lot of money from China going into the European Union, that's going to help their growth prospects going forward. Coupled with fiscal stimulus, they signed an agreement last year. It's going to be the first time they're going to be able to issue debt for the specific purpose of fiscal stimulus as jointly issued debt. Think about treasuries we issue here in the US. The proceeds from that treasury issuance is then spread across the states on a pro rata basis, depending on who needs it more, who needs it less, et cetera. Sort of the Hamilton moment for Europe happened last year. So we're pretty bullish actually on the outlook for European growth, for a number of other reasons, but this China deal that you just mentioned is part of that reason that we think Europe can actually have better than expected growth than we've seen over the past 10 years.
And when
Fantastic.
you say
Mike?
Europe, do you still include the UK, or does now going forward, do you have to bifurcate UK out of that analysis?
It'd be Europe ex UK.
Okay. Thanks, John.
Sure.
Well, John, can't thank you enough. We probably could speak to you all day. Hopefully you'll give us the pleasure to join us in the future again. Can't thank you enough for the time you took with us today.
Thanks, guys. Happy to be here.
Thank you, John.
New Year,
Happy
too.
New Year.
Happy New Year.
You are listening to the Lebenthal Report. If you're listening to the show live, join in on our discussion with questions or comments at 1-866-472-5790. You may also send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
And welcome back to the Lebenthal Report. And I'm Jordan Kimmel, the Chief Equity Strategist and Portfolio Manager. And when we started the show, we planned on doing it. Barry Ritholtz was one of the first guys I said we need to bring on. A colleague, a friend. Barry, thanks so much for joining us. He's the chairman and the CIO of Ritholtz Wealth Management. Thanks so much for joining us, Barry.
Thanks, Jordan. Thanks for having me.
So part of it is that not only have you grown your business tremendously, and I want you to talk about the wealth management part, but the blogging side, the podcast side, I think you are really ahead out front of everybody. And it's a new digital society. And I'll just give you a couple minutes to share kind of the several places where everyone can find you. Then I want to get into some process.
Sure. So a lot of what I do is just my way of dealing with being frustrated when things don't go the way I think they should go. Notice I'm not saying they don't go right or wrong. It's not that. It's that I'm annoyed how something is going, and I get frustrated. And people don't realize how the world has changed so much over the past 20 or 30 years. Not just technology, but when I was first coming up in the 90s as a trader, and then later as a strategist, they would take various mainstream media would take young green reporters and just throw them on the economic beat, and the reporting was often terrible. And I remember getting into an argument with an editor. No, it's not that we're selling more houses in May than we were in April. It's seasonal. You always bottom out December, January. Those are and then it gets better each month. You have to compare it year over year, not sequentially. It's like saying, oh, retail sales went up in December. You can't do it. So the blogging came out of frustration. Just let me show you how to think about analyzing stocks and markets and statistics and economics. You just had to apply very basic skills to do that, and then you could take it further. The podcasting, I host Masters in Business on Bloomberg Radio, and I've been really fortunate. We're up to about 400 episodes, and it's just been an amazing who's who of people in finance. But it was out of frustration watching TV and watching very short, very terrible interviews. So what's your favorite stock? When is the Fed going to cut rates? Where's the Dow going to be in a year? Thanks for coming. Cut to commercial. I'm like, no, I want to hear from this guy. So the podcast was just my way of saying, if I could get a Cliff Asness or a Ray Dalio or a Bob Schiller or a Howard Marks to sit down with me for an hour and tell me who they are and how they got that way, hey, that would be really interesting. And maybe some people might want to hear that also. And it turned out lots and lots of people want to actually hear that. So we're now in our 7th year of podcasting.
Turns out, Barry, a lot of people wanted to hear that. And part of it is not the soundbite, again, on the shows we're all used to doing where you get 30 seconds to tell your story. But here, a time to really lay into it. And you've never been one to pull punches. You've never been one to been non-controversial. So, tomorrow is a big day in the United States as a new administration. The way I do things at Magnet, as you know, is a bottoms-up quantitative screening process. I think you like to go the other way, the top-down, where things are going, then what sectors to use, and then how to play that into building a portfolio. So a lot of things going on tomorrow and change coming. What do you see? What do you want to say?
So assuming we don't have any major problems tomorrow, assuming things go the way they're supposed to and go normally, I think that you're looking at single party rule in DC for 2 years. And that anytime there's single party rule, it's always a good news, bad news situation. Doesn't matter if it's all Democrats or all Republicans. The good news is we're going to see a stimulus as far as the eye can see. Look back at 2020. People don't realize, and I make my libertarian friends crazy every time I say this, but Congress, channeling John Maynard Keynes, essentially averted another Great Depression. And just go to the Fred data set and pull up personal income. You could see from around March to November, another $1 trillion found their way to Americans' pockets after tax personal income. And you could see that show up in things like the increase in the savings rate. Retail was quickly higher than it was pre-pandemic once we passed the CARES Act. And the savings rate went up. Credit card delinquencies are at record lows. It was an 8% increase versus the same period the previous year. That's enormous. And to put it into some context, the great financial crisis, the fiscal side was about $782 billion over 4 years. This was $2.1 trillion over 8 months. So it was 4 times the amount. It was a fraction of the time. It had a giant impact. I think that experience is very much what's going to color this new administration. So there's the next CARES Act that's going to be $1 or $2 trillion. There's an infrastructure spend coming. There's a Green New Deal coming. I've noticed nobody on the media has been talking about the expansion of Obamacare. When Obamacare first rolled out and 35 million people suddenly became paying customers, what a surprise. It was great for healthcare, hospitals, and healthcare is a big percentage of retail sales. Pharmaceuticals, go down the whole list of that sector. I don't know what the plan looks like. I'm not that much of a DC policy wonk to track it closely, but the numbers we have been hearing have been anywhere between 15 and 25 million more people added to the who currently don't have health insurance that'll get it. That should probably be pretty good for the healthcare sector. If we see any sort of big increase in spending as is planned, maybe that gooses inflation a little bit. Maybe we see the deficit cause a little rise in CPI. That should steepen the yield curve. Historically, that's been very positive for bank profits. So while lots of people have been screaming, it's a bubble and big cap and big tech growth is a bubble, perhaps we're looking at a rotation away from that into small cap, into value. Emerging market seems to be catching a bid. So this is not, I was a trader and a strategist in the 1990s, and people keep making, who weren't around then, keep comparing this. Us old folks can look at the 90s and say, this is nothing like the 1990s. They're not even this is like 96, 97. We're not even close to 99, 2000 when things really went crazy.
Right, in terms of the nutty valuation and so on. So let me bring up another issue that's been bothering me a bit, which is the over-infatuation with just an asset gatherer that says, let me help you invest. I'm going to put you in the S&P and I'm going to gather some more assets. I have another appointment. And I think it's so important that whether it's bottoms up or top-down strategy, that there's a way of being in front of portfolios and not just kind of sitting there and being captive to what I think is just a large cap overindulgence. And there's a lot of other ways you need to be moving money. And I know that you use economic trends and political trends. So tell me what you think about this concept of indexing and maybe how you're approaching it in a better way.
So the broader context is indexing. I'm going to quote Bill Miller, who said it better than I ever could. Bill Miller said, the problem isn't indexing, it's closet indexing. If you're charging 150 basis points and your active share is 10, 20, 30%, well, those people should just go out and buy an S&P 500 ETF for 5 bips and forget paying high fees. The problem isn't active. The problem is expensive active that really is closet passive. So back to the podcast, I've been fortunate enough to interview people. Bill Miller is one. I was speaking to Ron Barron today is another. These track records that are just legendary. The person who runs the Fidelity Contra Fund, Will Danoff. Guy's been doing it for 30 years and he's been beating the S&P 500 by hundreds of basis points. So it's not that the market can't be beaten. It's that it's very hard to do so. And if you're charging a lot and you're expensive and you're not beating the market and you look like an index, well, then why bother? So I think people could do much worse than just buying an index fund and forgetting about it. The key is if you're going to be active, make sure you're getting what you pay for and don't just pay a lot of money for what's essentially practically an index anyway.
Barry, I said the same thing in my last book. 90% of people would be better off buying a series of indexes, blending them, and not reading the paper. But they come to firms like yours. They come to firms like Lebenthal for someone who wants to be a drop ahead of the curve, not just sitting there and kind of watching. So, I know you lean and you move certain ways. And so, Dominick at our firm runs the big, larger blended portfolios using low-cost funds. And Mike is all about income. So I want to let them come in, Barry. I know they were very happy to be joining us. So if Dom and Mike, the engineer, can come bring them in, maybe they have a couple minutes. And so Dom, Mike, Barry's probably one of the most willing to speak the truth. So have at it.
It's a function of bad memory. If I could remember the lies, it would be easier. Instead, I just try and say what I think is true, and I don't have to track what I said last time. It just makes life easier.
There you go.
So I'll jump in first, if you don't mind, Barry. So you actually touched on a subject we talk about all the time, and we run very low cost institutional class share ETF type portfolios. But at the end of the day, it's really about that relationship with the client where you can hold their hand through those difficult periods, right? You can have the lowest index fund on the entire planet, but if the client decides to bail last March when the markets were at their worst, then having a low-cost index or buying one completely on your own is really irrelevant. So I think the value added, yes, is trying to run really good disciplined portfolios, but really having that relationship when that client goes to that crisis moment, you can walk them through, take them away from the ledge, and keeping them in the game for the long run.
Right. And in fact, take it a step further. We found that if you're first thinking about this the day the market is down, fill in the blank, 10, 15%, it's already very late. You need to be very proactive about this. I'm fond of telling clients that market crashes are a feature, not a bug. If markets didn't crash, if there wasn't risk, well, then there wouldn't be a whole lot of upside. People have to recognize that reward is a function of risk. And what you want to do is take intelligent risk where you need to, not embrace too much risk, not leverage up, not be crazy, but recognize, hey, if you want to take no risk, you can own some cash or theoretically bonds that are yielding very little, and you're taking next to no risk. If you want a higher return than bonds are going to give you, well, everywhere along the way, you have to assume a little more risk. As long as you understand that, it's fine.
Barry, we are almost out of time on this segment, so I'm just going to ask you, you mentioned banking. Are there one or two other sectors that you favor in 2021?
Well, broadly, value has been underperforming for forever. I mean, the fields are filled with bodies of people who recommended value. It feels like if ever value is going to recover, this should be the year it does. And we noticed this rotation has already begun. Small caps very much caught up to big caps. You saw that begin in November and December of 2020. The big caps had just run away so much that it appears that, I hate the phrase profit taking, but there is something to, someone starts out with a 10% position, it becomes a 20% position. People shaving some of that back and they have put it to work somewhere else. You're not going to sell a little bit of Amazon or Tesla and buy Apple or Netflix. You're more likely to rotate out of some of those bigger things into either a small cap or an emerging market or something that is just so unloved and out of favor and cheap. And I think value, emerging market, and small cap are probably the most unloved and the cheapest sectors in the market. So if anybody wants to just trim a little bit off of what's done great, you could put money into those spaces. You may not feel like a genius right away. It may take a couple of quarters or even a couple of years, but over time, you have to assume that mean reversion will eventually rear its head.
Thank you, Barry.
Barry, we ran up against the clock. Thanks so much for coming on with us. And we're going to be right back with more of the Lebenthal Report following a real quick break. Thanks, Barry, so much.
Thank you again.
My pleasure. Thanks for having me.
You are listening to the Lebenthal Report. If you're listening to the show live, join in on our discussion with questions or comments at 1-866-472-5790. You may also send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
Welcome back to the Lebenthal Report. I'm Michael Hartzman with Dominick Tavella. Dom, Barry's comments were pretty interesting. The one thing that leaped out to me was his forecast of 4% U.S. growth and 5%, EU growth. So those are pretty healthy numbers.
Yeah, I think we might get short term. The first quarter I think is not going to look pretty, right? We're still going to be right in the middle of this virus, and we're not going to see any significant economic change. But starting with the second quarter, and I've described it as a dimmer switch where we're slowly putting the light on, right? It's not going to be an on and off switch. So I think by the third, and especially by the fourth quarter, God willing, we're going to see really, really strong economic growth. It'll average out amongst somewhere in that 4 to 5%. I think that's a realistic number. I think we can hit it.
It's really amazing. I mean, it just remains, a tale of two countries, where the savings rate has never been higher, the debt ratio has never been lower, and then there's this other group of people who unfortunately continue to suffer. But and it is kind of obvious that the savings rate would be high and the debt ratio would be low if no one has anywhere to go to spend any money.
It's a constant conversation that people would love to spend the money if they had the opportunity. I think I heard from a client today, he's done renovating bathrooms. He doesn't have any more bathrooms to renovate. So people were spending money in their homes and renovating their homes, but they're done and they're ready to go out there. So I have all the faith in the world in the American consumer and their ability to find a place to spend the almighty dollar. And I think they will aggressively, especially by the third quarter. And I just want to bring up one point before we run out of time that Barry brought up. And I sort of I'm not trying to be funny when I say this, but the concept of selling high to buy low. And how many times, Mike, we get it where we're rotating the portfolio, we're getting out of a position, the client calls up, why'd you sell that? It's doing great. And you're like, we want to sell high to buy something that's low. What a concept, sell high to buy low. So that's the intelligent rotation in a portfolio, again, trying to get the message across to our own clients that you need to be proactive about it, because by the time the market figures it out, it's probably too late. So I thought that was a terrific message on Barry's part.
Absolutely. And just finally, Dominic, we don't talk about it that often, but we do have a YouTube page. And why don't you just tell our clients where they can actually see the podcast rather than just listening to it at Voice America, because we are downloading the podcast to our YouTube page. So what is the address of that?
Lebenthal Global Advisors on YouTube. All these podcasts will be on it, along with all our other public interviews, network interviews, and including some newsletters. So we're putting a lot of content there for people who can't be with us right at the moment we're doing this live.
So when I see you next week, we'll have a new president, a new administration, new things to worry about, and new things to be excited about.
Here's to new beginnings, Mike.
Absolutely. So I will see you next week. It was another great show, and thanks for listening, everybody. Have a great evening, all.
Stay safe. Wear your masks.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.